Your company may be overpaying its sales and use tax and not even know it. Stick around while these industry experts explain how that happens and, more importantly, how you can prevent it.
Welcome to the AP Now podcast, the podcast that covers trends, insights, and emerging issues impacting every accounts payable function.
Welcome to episode 95 of the AP Now podcast. I'm joined by Greg Anderson, CIO of pcardtax.com, and our very own Recharged Education's Lynn Larson to discuss avoiding costly sales and use tax overcharges. Let's dive right in. So, Greg, are overcharges actually a thing, and how does it happen?
Well, they are really a thing. And to be honest, when we do a lot of work with mid-sized companies, we find situations where the overpayments of sales tax can range from between $300,000 and $500,000 annually, which really adds up because you have a 3-year window to recover that, and it can be a recovery to your company of over $1.5 million. But before we go much farther, I do want to talk a little bit about what we mean by sales tax. And through this, we're going to use the term sales tax, but that's going to apply to two different types of tax. That's going to apply to the sales tax, which you as a purchaser pay to your vendor or your merchant, and that's going to show up on an invoice. You're going to pay that to them. They're going to remit that to the state. But another important component of that sort of sales tax category is going to be the use tax. So when you, as a corporate purchaser, aren't charged sales tax for a vendor, it's your obligation to determine whether or not that purchase is actually exempt, or if you have to accrue use tax and pay that to the state that you're located in. So just be sure that you understand that it's both the sales tax paid to the vendor and the use tax that you have to accrue as a corporation. So if overpayments keep happening, because these have been happening forever, why don't they get fixed? That's a really good question. I asked it for you. So at least 4 factors we look at in a typical business. Number one, mistakes happen on an invoice by invoice basis. And that's sort of like death by 1,000 cuts, right? Because, it's a small mistake on a single invoice. Do I really care, right? So if that happens on a lot of invoices, though, and nobody ever goes to fix it, over time, that's going to cost you a lot of money. Now, the second reason internally is because there usually isn't an efficient way for those errors to get communicated. So I'm an AP or I'm in procurement, and I see that we've gotten a purchase where sales tax has been charged. In my little heart of hearts, I know that this is an exempt purchase, but I don't necessarily know who I'm supposed to go and talk to. So that's another reason that it gets dismissed. Now, even if the sales tax, if that particular sales tax error gets fixed and somebody goes to the effort of short paying a vendor, which is ungodly complicated, there's no way that it gets fixed going forward. And so that fix isn't going to stay in the system. So those are on the sales tax side, but then on the use tax side, an AP person sees a transaction with no sales tax on it, or the system is set up to not recognize that transaction. The default position is that, oh my gosh, it's tax. Tax is really important. I don't want to underpay my tax. There's all kinds of problems when I underpay my tax.
Right.
There's 100 reasons why people overpay sales tax when they really shouldn't. And that's on the company side. So that's really people kind of going the extra mile and overpaying something that they don't really have to pay for. Now, there's also external reasons. And so one of them is, and a lot of people on the procurement side don't understand this, but there's 45 states that collect sales tax and require their vendors to collect sales tax. And you know what? Every state has absolutely different rules. So even if you're a manufacturer, and it's relatively simple, you think it's relatively simple, because for manufacturers, usually machinery and equipment used in the manufacturing process is going to be exempt. But some states say, well, you know what? we're only going to exempt it if it increases your production capability. So then you have to go through a whole analysis of whether or not this single transaction is exempt or not. And the default position would be, I don't know, I'm just going to accrue the tax, or a vendor's just going to pay the tax. So the rules are complicated, 45 states. So this is absolutely one of the reasons why the same operations in different states are going to have tax errors at different rates. Another factor, the Supreme Court, and I suppose you're thinking, oh my God, it's just sales tax. What does the Supreme Court have to do?
No, I know.
Don't they just do the big stuff? Well, you know what? They do just do the big stuff, but for a very long time, sales tax transactions were the bulk of their decisions, because sales tax, well, it's run by the states. It all has to apply, to comply with the rules of the Constitution, right? So there's constitutional rules that say, you just can't do that. So what the Supreme Court had originally said allowed us to make all of our purchases from Amazon exempt from tax. That was really miserable for corporations, because corporations get audited on the accrual of use tax. Individuals don't. Well, then the Supreme Court ruled on the Wayfair case. And in the Wayfair case, what they said was, all of you online sellers that aren't collecting sales tax, but have tons of transactions in all these other states where you don't have a physical presence, have to start collecting sales tax. So now what you've got is the B team of retailers, the rookies, are out trying to do their best to comply with the Wayfair ruling. And what they're doing is, when in doubt, collect the tax. So you're going to see a lot of the vendors where you were used to not seeing sales tax collected, collecting sales tax. And if you were accruing use tax on those, surprise, you could be paying sales tax to them. And because you've got them set up to accrue use tax on them, instead of paying an average of 8%, you're paying an average of 16%, because you've double paid tax on that transaction. I know, doesn't make anybody happy. If you're on the,
it adds up. It can be a lot of money.
oh my gosh, you know what? A procurement group will be really, really ecstatic if they can negotiate with a vendor and get a 4% discount, or a 5%, or a 3% discount. And then all of a sudden on the tax side, we blow 16% on that transaction.
Yeah, you give it all back.
It's just, and those donations to the state tax fund are not deductible, just so y'all know. All right, so here's the other thing. If you're on the procurement side, you probably don't know what the vendor's perspective is. So a vendor is not going to charge you sales tax unless they have a documented, physically documented reason not to charge you sales tax. And that physical documentation is called an exemption certificate. Now, everybody's getting new software to manage their exemption certificates. That software is going to automatically, unless you change the settings, the default settings are generally that the software on the vendor's side will expire those exemption certificates in 3 years, even in states where exemption certificates don't expire. If your exemption certificate at that vendor gets expired and they don't ask you for a new one, their system defaults to collecting tax on all of your purchases. If you've sent them an exemption certificate that isn't complete, here's one of the common problems, is that that vendor doesn't necessarily know who to communicate with to indicate that that exemption certificate is incomplete or not in compliance. And if that message is never received and a corrected exemption certificate is never provided, that vendor is going to charge you sales tax. Here's why vendors do that. I know that it seems kind of harsh, because they're your buddies, they're your partners, they're your business partners, right? Well, politically correct. So the reason they're going to do that is that if they get audited on the transactions that they didn't collect tax on an otherwise taxable transaction, it's their responsibility to pay the tax. And so they are very careful and very diligent about managing their exemption certificates. So that's just another reason to say, wow, I mean, we have to take responsibility on our side, because we can't count on our vendors to manage our sales and use tax liability. So the reason in this little series here is to talk about the limitations merchants have on collecting and exempting your sales tax, right? Let's say that you are purchasing from a vendor that sells you both taxable and exempt items. More likely than not, that vendor has a choice. They can either, well, and you have a choice too. You can either choose to be entirely exempt with that vendor or entirely taxable with that vendor, but you can't say, hey, we buy 3,423 items from you, but we need to be exempt on 1,247 of them, and here's the list. They can't do that. And so in that respect, you know, a lot of times people just leave that with the Grangers and the MSCs and the McMaster cars where you buy this whole basket full of goods. And so somehow you have to take responsibility for being able to manage that sales and use tax responsibility on your side. Your vendor can probably only treat you as taxable or exempt.
And to be fair to the vendor, they're going to look out for themselves before they look out for you. So when in doubt,
Exactly.
collect the tax. All right, Greg. Before we turn to Lynn, and we are going to get to you, Lynn, could you tell us a little bit about the services that your company offers? And for anyone who's interested, we'll have a link in the show notes so you can go directly to Greg.
Well, what we do is that we have tried to do our best to simplify the whole compliance side on sales tax validation and use tax accruals. Because you got to remember that the original sales tax was developed back in the late 70s, early 80s. So that was developed on huge mainframe platforms, very difficult to manage. I mean, if any of you had to take COBOL when you started school, you know how difficult it is to go in and change anything or fix anything. So our company really focuses on the power of the laptop. And so we want to get people off of these huge systems that have hundreds of millions of lines of code and hundreds of employees that support that, and get people on a laptop platform based on things like spreadsheet capabilities, because most of what you need is already built into things like Excel and Access. So our goal is to develop a very inexpensive piece of software that is easy to access and learns every time you go in and fix something, it's going to correct that going forward. So I think one of the biggest hurdles to people using complicated software is it's very difficult to go in and make a change. I mean, you can't expect the tax guy or the procurement person to write a script to exempt purchases from a vendor.
Nope. So folks, if you're interested in learning more about Greg's inexpensive, he said inexpensive product, look in the link and you can contact him directly. So Lynn, you see sales and use tax overcharges on cards. As most of our listeners know, you're the, at least our card expert and most of this country's card expert.
You know, Mary, I actually see a lot of issues. I'll touch on something Greg said too in a minute, but a lot of issues for tax exempt organizations. You know, and as Greg mentioned, you know, vendors either have you down as tax or no tax, and sometimes there's something in the middle. So, you know, even private sector experiences overcharges, given the example he already shared. But I think, you know, what I see is these tax exempt organizations don't always have an easy time getting vendors to exempt the tax. And, you know, Greg and I have even talked about this offline a little bit, you know, and imagine one scenario where a cardholder is purchasing something online. Most vendor websites do not offer the ability for the cardholder to specify, hey, we're tax exempt. You know, usually it's an extra process, you know, manual in nature, providing that tax exempt certificate. So that, you know, there are issues there. And I know, Greg, you and I talked about a couple other things. You know, it's difficult to monitor if tax has been charged sometimes, and sometimes the level 2 data that accompanies card transactions. Level 2 is where the sales tax amount is broken out into a separate field. That doesn't always match what's on a receipt. So you have issues like that. And so, you know, I've dealt with tax exempt organizations who have said, you know, our receipt shows we don't have tax charged to us, but yet we get that P card transaction coming down the pike, and it looks like something is in that field that we did pay tax. So, I see lots of issues, and, we could make this an hour-long podcast, and I won't. But, what I want to impart on everyone listening is just the fact that the broader issue really is that organizations don't address sales tax broadly from a P card perspective. And I know Greg was waving at me because he had another reason why, overcharges can take place. Greg, I don't mind if you chime in, but if you want to share that.
No, I was just going to say that, when you said we could make this another hour, I was saying maybe 2, maybe 3.
Oh, okay.
I mean, because, people hear tax and somehow they don't think it's fun, but it's just because they
Can you
haven't done
imagine
it.
that? Could you imagine that? All righty. So what people are interested in, Greg, is how they can avoid making overcharges. I mean, they probably like to avoid the tax completely, but let's just be realistic. How can they avoid overcharges on sales and or use tax?
Well, you know what? This is the most interesting part, and I think it's the most revealing part of the fact that people hear the word tax and they just want to walk the other direction. Because the first step in this is that you need to understand what your organization, how your organization manages tax. So if you're on the procurement side, if you're on the AP side, if you're on the tax side, I mean, a lot of times this data just seems to go in a black box and we hope that it's right. Or maybe it doesn't even go into a black box. We just take what the vendor charges and we hope for the best. And so the first step in doing that, and I know that the minute I say, get a group together, like one person from procurement, one person from AP, and one person from tax to kind of look at this, it's a lot more fun to do these live because you will see like 300 sets of eyes just go, oh God, no. He really wants to work with the tax guy, and I mean the tax guys are boring and whatever. So I mean you really have to kind of diagram what the process is before you can find the weaknesses. And maybe there aren't any, but if you don't have that process defined, there's no way you can put that line in the sand and move it forward. So like I said, you're going to set up a group. You're going to decide that, we're going to look at our transactions and make a decision. And again, there's this audience-wide eye roll that says, oh my God, we purchased so much and I can't possibly look at all that transactions. And you got to remember, you got to look at these line by line. And so then people, it's not just the eye roll. Then people are going, oh my God, I can't do
Line
that.
by line, state by state, Greg.
What's that?
Line by line, state by state.
Yes, because every state's different. So, it's kind of complicated, but here's the thing. You need to separate and look only at what's going to make a difference. And so here's the things that you're going to kick out. And these are like the big ticket items, right? So you're going to get rid of all of your direct materials because nothing in raw materials in any state is taxable. And there aren't any things you can say that are consistent across all 45 states. So if you're in a service business, like let's say that you're a company that does HVAC, okay, so you're going to make specialized parts, you're going to do some manufacturing, you're going to do some reselling, you're going to do some installation, and you're going to do some repairs. Well, get rid of all of the stuff that is related to that process because for the most part, it's all going to be exempt. Office supplies, huge number of transactions, hundreds of millions of lines because every box of paper clips has its own little line, right? Get rid of that. Get rid of all of your services because legal and except if you're in South Dakota, none of this applies because everything's taxable in South Dakota. But anyway, so services, office, legal, accounting, HR. But I'll tell you one thing about HR. They do buy a lot of stuff that I've seen tons of tax accrued on. So for example, if they do an ad on Indeed, if nobody knows what Indeed is, they're going to accrue tax on it because Indeed isn't going to charge tax. And all it is, it's a digital job posting, not taxable. So something to look at there. And then set a spend threshold, because well, and get out all of your T&E and restaurants and hotels and all that kind of stuff, because all that T&E stuff is out too. But set a spend threshold so that you're going to eliminate all those one-off vendors where you might have had an engineer at a client location, he bought a part and got charged tax. You don't really care because you're not going to look at that. You just want to look at the big spend, right? Because all you're trying to do is kind of right size what you think your error rate is so that you can make a better choice on what kind of a solution you're going to have. So here's what you're going to include. I mean, if you exclude all that, you can just take the rest, but here's specifically what you're going to include. You're going to include all of your maintenance, repair, and operating purchases, your MRO, and that's like lubricants, chemicals, and parts, and all of that kind of stuff, because those can go a couple of different directions. And if you tax all of your lubricants and you're a manufacturer, well, or let's say you're taxing all the lubricants you buy from a specific manufacturer, that's probably wrong, because some of that is going to be used in maintenance, but everything used in manufacturing in most of the manufacturing states is going to be exempt. So those are the kind of details you want, because again, sales tax overpayments, death by 1,000 little bitty cuts that happen again and again and again and again. Then the other thing you're going to want to look at, because this is where we find huge errors when we have to do sales tax refund claims for people and get them money back from overspending, it's the vendors where you buy mixed transactions. So this is going to be the Grainger, the MasterCard, the MSC, because they can supply an awful lot of stuff that's used either in your service business or in your manufacturing business that's going to be exempt. And a lot of those folks, they can't manage all of your items. They have millions of part numbers in their catalogs, right? And they can't say, okay, John's company, okay, well, here's the 4,500 things that they're exempt on. So, that's not their responsibility. They're going to say you're either taxable or exempt. It's a choice you have to make if you give them an exemption certificate or not. If you give them this exemption certificate, it's your obligation to accrue use tax. So somehow someone in your tax department has made that choice. So those are in terms of items to software, you got to look at software, because software used in the manufacturing process, if it's the easy distinction is to say if it turns equipment on or turns manufacturing equipment off, it's exempt because it's part of the manufacturing process. The other issue in all the states is that software that's located in the cloud is not physically present in your state, and you didn't really take delivery, you're accessing a service. Those rules are kind of in flux, so you need to be really careful, but software is another big one. I know that there was one huge software company that was billing people $300,000 and $400,000 a year for a couple of different applications, and they couldn't get the tax right. So you really want to look at that, because those could be some big ticket misses. And then the other thing is computer hardware, because if you have computer hardware, who knows where the heck it goes unless you're tracking them on an individual basis. But trust me, a laptop with CAD/CAM software on it, that's going to be exempt in just about every state. But those touch screens, I mean, do they turn machines on or off? That's a big decision. And so that's, in our business, this is where we find the bulk of the really, really, really expensive mistakes. So once you find that sample, it doesn't have to be a big sample. So, it's not like, you have to do the old college bell curve, you can just pick and choose, because remember, when your state auditor comes in to do a state sales tax audit, everybody thinks that that's going to true up your tax payment. It doesn't, because sales tax auditors are there to collect the tax that you've underpaid. They don't really care about any tax you've overpaid. If they find it, they'll give it to you, but they're not looking for the categories where you commonly have overpayments.
So let me ask you, in sales and use tax audits for the states, are many of them using third-party auditors, or most of them are using state employees?
Oh, the bulk of them are using state employees, and for the most part, I do a ton of. I'm in Minnesota, and I only have good things to say about the state of Minnesota auditors. Very professional. Most of the state auditors I've worked with are really good. But I think people get frustrated with state audits mostly because it's very difficult to give enough information to an auditor to take an item out of the taxable category that they've identified and put it in the exempt category, only because there's not enough communication between AP, procurement, and tax inside the company. Because when I go in and do a reverse audit and try to get money back, those are the people that I go to, and they're like, "Oh, nobody's ever asked me that." Well, I'm glad you asked me that, because that was used on a capital project. That capital project was used to expand production, and everything related to that capital project should be exempt. And here's why: because the auditor has to know why. It's
Okay.
hard.
It is hard. It's not easy.
Yeah.
So before we get to our last question about the three most important issues that every organization should focus on to make sure they don't pay too much, I'd like to remind listeners to subscribe to this channel. And if you're watching on YouTube, please hit the bell at the top. And now, for the big question everyone's waiting for, what are the three most important issues every company should focus on to ensure they do not pay more sales and use tax than they are absolutely required to?
Okay, well, I cheated. I have 5. So, number 1, based on based on your internal review, and I'll just go back and say, try to make that as efficient as possible, because nobody from tax, procurement, or AP has time to do that. So try to make it as efficient as possible, and try to get group support behind you to be able to do that. And then evaluate your options for an approach that is going to be cost effective to your solution. Because if you found out that you're only overpaying by, each location is maybe only $100,000 a year, and it's adding up to $500,000, you don't want to pay $100,000, a year in a license fee to be able to, recover that small amount. So you want to be very cost effective and very good about defining what your overpayment is. Research your software and vendor options. There's basically 4 options. One is to do it internally. And again, when I'm doing these live, that's when I get the big eye roll and everybody goes, "Oh my God, nobody has time to do that internally." But you have, the big vendors, you have sort of those mid-tier vendors, and then, you have some options where you're going to rely on your suppliers, and really working on your exemption certificates and your whole compliance perspective from that side. The last thing I'm going to say is, and that's number 4, because you said only 3, but this is the bonus round. So don't wait, because there's a statute of limitations that applies to all of these payments. If you have done any big projects in the last 2 years in most states, that is going to fall outside the statute of limitations, and you're going to lose your chance to recover a lot of those big dollars in 3 to 5 years. So don't put this off. This is something that every day goes by, a certain amount of money falls off the table. So do it. And if you present this right for the team that you put together, this could be a big win within the company.
Okay, good advice. If you like this episode, you might also like episode 71, where Lynn joins us for a discussion about other P card challenges. Now, if you're listening on YouTube, the link will appear to the left momentarily. And don't forget, we do always appreciate those thumbs up if you like this discussion.